A 4-day decline in the US dollar was stopped by disturbing inflation data from the Eurozone and the pessimistic forecast provided by the Bank of England. Let us focus on the details of these events. The final Eurozone inflation data for February unveiled that the consumer price growth pace accelerated to 5.9% from 5.1%. Economists had expected a smaller rise to 5.8%. At a first sign, the difference is insignificant. However, the data exceeded all their expectations. It means that in March, inflation will be significantly higher than anticipated earlier. Notably, the ECB's representatives are still sure that by the end of the year, inflation will slacken and even return to the targeted level of 2%. Meanwhile, the Bank of England decided to tackle the issue and raised again the benchmark rate to 0.75%. Importantly, the UK regulator radically revised inflation forecasts. Thus, the peak may occur in April, when consumer price growth will accelerate to more than 7%. The worst thinkers say that inflation will need at least 2 years to decline to 2%. However, according to the official press release, the process may take even 3 years. There is no doubt that Western Europe will face unprecedented inflation growth last seen several decades ago. Unlike the Fed Reserve, neither the Bank of England nor the ECB are demonstrating readiness to take necessary measures to curb inflation. And this fact is frightening investors who are trying to withdraw their funds from Europe amid the situation in Ukraine. Let us shift our attention to the trading charts. The euro-dollar pair managed to continue its correctional movement. As a result, the price hit a new weekly high. However, the pair failed to break the resistance area of 1.1120 and 1.1180. Despite high bullish activity. If the price consolidates above the resistance level on the 4-hour chart, it's likely to continue its correction. And then the pair has a chance to pull back, thus causing a downward correction. Meanwhile, the pound-dollar pair returned to the local high recorded on March 10. There, we can see the resistance area of 1.3180 and 1.3200. When the price approached this area, the volume of long positions dropped, thus slackening the correctional movement. Under the current conditions, a slower correction may point to a change in the market sentiment. Traders may receive a sell signal if the pound sterling settles below 1.31. The alternative scenario will become possible if the upward correction continues. A buy signal will be received if the price consolidates above 1.32 on the 4-hour chart. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.